So Cindy, thank you very much. Which brokerage are you?
So we have our own brokerage named GAEA Realty.
Oh, cool. Very, very nice. Yeah, I know that Jennifer set this up, but she's out today. So I'm very
Mhm.
happy to meet everybody. For those of you who are hearing this on a recorded version, everything I'm going to say is still valid. You're still welcome to call me anytime with any questions. So let's start with sharing my screen with the stage. You can all see my slides.
Yeah.
Wonderful. All right. So let's go start from the beginning. I'm going to assume everybody has very little knowledge about exchanges, but if you have some, I still think you'll find this very valuable because we are going to get into some more deeper areas to study when it comes to how you can use 1031 to get more business, because ultimately that's what we all want, is to get more business. By the way, that QR code, if you want to scan that, that just downloads my information onto your phone. So if you want to have that, capture my information as a resource for you, I'm happy to do so. Let me start by saying that, okay, let's start at the beginning. My name is Ron Ricard. I work for a company called IPX, or Investment Property Exchange. We are
Hmm.
what is referred to as a qualified intermediary. So we help you and your clients do 1031 exchanges. And that is what I've been doing for over 24 years now. So quite a long time. Yes. So let's start at the beginning. What is 1031? 1031 refers to a section of the tax code. It's a section of the tax code that says, in essence, that when you own real or personal property used in business or investment, you can sell that asset, buy a like kind asset, which we will define in a minute. And as long as you follow the rules, you get to defer paying taxes on the profit that you've made. So, what does that mean in English? You have a client with a rental house there in Cupertino. They want to sell that and buy a duplex. So, you list the property, you go through the regular sales process. At the close of escrow, the money comes to a third party called the intermediary. That's us. So, you then go into contract to buy that duplex they want to go buy. We send the money to the escrow officer on that side, and the property closes. In the eyes of the IRS, they sold a piece of investment real estate and they bought a piece of investment real estate. And because they didn't touch the money, because we had it, they get to defer paying taxes on the profit that they've made. Now, important word there: defer, not eliminate. So if I have, oh, by the way, one thing I should mention: if you have any questions, please put them in the chat box, and at the end, I'll go through all the questions at that point. When I talk in person, I like to do it interactive, but on Zoom, it's much easier just to put your questions in the chat box. Anyway, you are just deferring taxes. So if you do a 1031 exchange from the house to the duplex, and later you sell that duplex and buy a fourplex and do another exchange, and now after a few years you're tired of real estate and just cash out, you pay taxes from the house, the duplex, and the fourplex. You're just deferring, just delaying paying those taxes. Now, sometimes people will ask me, well, if I'm going to pay the taxes anyway, who cares? I'm going to have to pay the taxes anyway. There are two reasons we always encourage our clients to do an exchange. Number one, do you want to pay your taxes today or tomorrow? For most of us, the answer is tomorrow. The way I look at it is this: if you make, let's say, $600,000 of profit on a property, you're going to pay about $200,000 of that in taxes to the government. What would you rather do? Give that $200,000 to the government, or use it yourself to buy more real estate? For most of us, we want to use it ourselves to do something we want to do with. But the real reason we do exchanges is, when do you really want to pay your taxes? And the correct answer is never. And guess what? You don't have to, because ultimately, eventually, one day, sadly, we're all going to die. And when you die, you win. Well, be honest, when you die, your children win. Because when you die, whoever inherits the property from you gets what's called a step up in basis. This is very important to know, and let me make sure you understand this. I bought a property many years ago for $100,000. Today it's worth $1 million. If I sell it, I have a $900,000 gain in the property to pay tax on. But the day I die, whoever inherits the property from me, their basis is the value of the property when I pass away. So if your children are like mine, the day after my funeral, they're selling all my real estate. And when they sell it for $1 million, how much taxes would they have to pay? Zero. It's worth $1 million when I die. That becomes their basis on the property. And because of that, they can sell it and have no tax obligation at all. All the taxes I would have paid all disappear when I die. That's the real beauty of the 1031. So, by the way, very important to note, this does not work if you give real estate to your children. It only works when they inherit it. The reason I point this out is, especially if you're working with people who are born in other countries, it's every country's tax rules are different. In many countries, you give your real estate to your kids before you die so that you're not taxed on it when you pass away. The way our tax code is written, it's much better to inherit property than it is to have it given to you while you're still alive. So again, the step up in basis is for when you inherit property. All right, enough about dying. Let's move on to the 1031 itself. There's a term I use in the beginning that's very important. The term is like kind. What you sell and what you buy have to be like kind. That's a very misleading term. Any kind of business or investment real estate can be exchanged for any other kind anywhere in the country. So you can sell a rental house and buy a commercial office building. You can sell a farm and buy an apartment building. You could even sell land and buy commercial or residential investment. As long as what you're selling and you're buying are investment real estate, it can be any kind of real estate. One thing I will note is that we used to do exchanges on things other than real estate, which is why we have the term like kind. In my 20 plus years of doing this, I've done exchanges on farm equipment, on airplanes, on boats, on artwork. So when you sold a boat, you had to buy a boat. You sold a piece of art, you had to buy a piece of art. You sold a farm equipment, you had to buy farm equipment. That's what like kind referred to. In 2017, the tax code was amended, and all all exchanges were eliminated except real estate. So now 1031 is only about real estate. So that's why that term really isn't very important anymore. A couple others, permanent easements, leases are all exchangeable as well because they are still considered to be real estate. Now, the truth is, what kind of real estate does not qualify for 1031? The first answer is your primary residence. Your primary residence has a separate tax rule, Section 121 of the tax code, that says when you own property that you've lived in for at least 2 years, you get an automatic exemption. If you're single, you get to keep $250,000 of profit in the property. If you're married, you get to keep $500,000. Now, that used to be a lot of money back in 1997 when they passed the law, but unfortunately, they didn't adjust that number for inflation. So now, when somebody sells a property, it's very common for them to have at least $500,000 of gain in that property. So because of that, a lot of people are going to pay a lot of taxes. Now, one thing to remember is that the law used to be when you sold your house, you needed to go buy another house. That's not the case anymore. That was eliminated. Now, when you sell your house, it doesn't matter if you buy another house. If your gain is more than your exemption, you pay tax on whatever that excess gain is. Now, a lot of people say, I don't want to pay taxes. Is there anything else I can do? Yeah, there are a couple things. First off, does any portion of your property qualify? Do you have an ADU? Do you have a home office? Is there any portion of your property, very importantly, that you are declaring to the IRS today as the business or investment portion of your property? If there is, your property can qualify for both at the same time. So, I mean, a simple example, a duplex. I live in one side, I rent out the other. Portion of the property is primary residence, portion of the property is investment. And so using this example here I have in front of you, $1 million property is sold. 20% of it is declared on the tax return as business or investment property. So 20% of the sales price goes into the 1031 exchange, and the other 80%, you still get your full $500,000 or $250,000 exclusion against. So you can have a property that is both. The reality, though, is most people do not have a home office, at least one that they declare on their taxes, or they do not rent out any of their property. So What can those people do who have a very highly appreciated primary residence? Move out, turn your house into a rental. Now, after you've been renting it for a year or two, is that house now an investment property? The answer is yes. Is it still considered to be a primary residence? Yes, because it still qualifies as having lived in the property 2 of the last 5 years. So when you look back 5 years from today, did I live in the property at least 2 of those years? If the answer is yes, you could take advantage of both tax rules at the same time. So let's say the property sells for $3 million and you're a married couple. You get to pocket $500,000, and then you can do an exchange on the remaining 2.5 million. Now, this does not work for everybody. If you need the money from your house to go buy a bigger house, obviously it's not going to work. But if you are moving into a retirement community, or maybe moving in with your children, or into a second home, or maybe you have enough money to go buy another house without selling yours, this is becoming a very common tax strategy. The other thing to remember, though, is that you are buying equal or greater to whatever the sales price is minus the exemption, not the excess profit. So if the property sells for $3 million and you're single, you get to keep $250,000, but now you need to still put in the remaining 2.75 into the exchange. We'll talk about the dollars in just a little bit. So anyway, this is a very important thing for you to realize, is that people who have highly appreciated primary residences have a long-term strategy to get out. Now, one thing when I talk to people who have properties that may or may not fully qualify for 1031, I always say with enough planning, you could almost always avoid the taxes or defer the taxes. This is a perfect example. With enough planning, you can do so. All right. So what other kinds of properties don't qualify for 1031? The first one is flips. You buy a beat up old house, you fix it up, and you sell it. The IRS calls that a property for resale, not a property for investment. So if you are flipping property, if you are buying property that you're just fixing up and selling, that is considered to be ordinary income. It does not qualify for 1031 because it is not considered to be investment real estate. Same thing with development. If you buy a property, build a house on it, and sell it, like a spec house, that is not considered to be investment. That's considered to be a job. You basically are bought the land because you know that you can build on it and sell it and hopefully make money that way. Also, you cannot exchange into any kind of non-direct ownership of real estate. So any kind of partnership or syndication or REIT, you are not buying real estate. You're buying shares in a company who have real estate, or you're buying a share of a partnership who owns real estate. So you, in an exchange, you have to have direct ownership of that real estate. Also, you cannot exchange any kind of second home. Now, by second home, I mean, that little house that you go to on weekends, or in Tahoe or in the beach, or that's only used for you and your family. That kind of property does not qualify. Now, this also means any property that you're letting family member live in that you are not collecting market rate rent is not considered to be investment real estate. So if you have family member living in the property, you have to treat them like a regular tenant in order for it to be considered as investment real estate. Let me
Oh,
also, yes,
Ron, I have a question can you
listen.
go back to the previous page for how to define the flip? Because we have a case, we buy a fix upper and we flip it, but we are not sell right away, and we now rent it. So probably we rent for 1 or 2 years and we sell it. We sell it. This property, is that considered? Can we do 1031 exchange for this property?
Yes, yes, because I mean, you're eventually, the last use of the property is as a rental at that point. So, the question always is, how long do you have to rent a property for it to be considered investment? And the IRS does not give a black and white number to that. Most accountants say, to be safe, you probably want to rent it 2 years, but
I see.
one to 2 years is, yes. The thing is, most people who flip real estate they know what they can, they can buy it today, fix it up, and they know what they have a pretty good feeling what the market's going to be like in 2 or 3 months. They don't know what the market's going to be like in a year or 2 years from now. So a lot of people don't, who are flipping real estate, don't want to hold it long term. But if that is part of your strategy, yes, that is something you can do as well, as long as after you do fix it up, you put a renter back in the property.
I see. Thank you.
All right. Going back to second homes, I do want to distinguish. There's a difference between a second home and a vacation home or vacation rental. I'm talking here Airbnb, VRBO, that kind of property. A property that is held as a vacation rental does qualify, but the IRS has very strict rules on this. Essentially, the property must be rented out at least 14 days, at least 2 weeks per year, and you and your family cannot use the property more than 2 weeks per year. And you must do this for 2 years. I refer to it as a 222 rule. Rent it at least 2 weeks, don't use it more than 2 weeks, and do it for 2 years. So if you have a property that you go to and you're there for 4, 5, 6 months at a time, and you rent it while you're not there, probably does not qualify as a vacation rental because you're there too much. So again, the takeaway here is a vacation rental does qualify, but a second home does not. All right. Now, you as a realtor have a new listing. It's going to be part of a 1031 exchange. What is your role as an agent in the process? The answer is there's very little for you to do. Everything about your listing of the property is going to be just like any other listing. Same MLS, same tour, same listing agreement, same purchase contract, same title company, same everything. There are only three little things I want you to do extra if your client is going to do an exchange. Number one, please make sure the client understands the rules of the 1031. And if they say they Googled it or they asked Chat GPT, that's not enough. Okay, there's a lot of misleading and conflicting and bad and incorrect information on the internet, especially from those AI chat boxes. So please educate the client. I have brochures I can provide you. I have them 10 different languages. I have a Chinese speaking and Spanish speaking people on staff that can talk to your clients. Um, I'm happy to talk to your clients at any time, even before you list the property. You're welcome to give them my name and number. I do not need you to introduce them necessarily. I'm here, happy to talk to anybody who has questions about 1031. But please do not assume that your clients understand 1031. It's a very, I won't say difficult process, but it's a very confusing process. And there are a lot of people who have very serious misunderstandings about it. So please make sure the client understands the rules of the 1031 before they start. Number two is you do need to put something in the contract disclosing it to the buyer. This is sometimes referred to as the cooperation clause. Buyer to cooperate with seller's 1031 exchange or seller to do 1031. If you don't know what to put in the car contracts, there is the seller's intent to exchange addendum, the SXA form that you can use also. The key here is it is strictly a disclosure. It is not a contingency. It is just disclosing to the buyer that the seller is doing a 1031 because technically what we do as the intermediary is we step into the contract. So that's why everybody needs to be told we are stepping into the contract. So educate the client, disclose it to the buyer, and please remember you need to call me before escrow closes. If escrow closes and you have not enlisted with the intermediary, escrow will then send the money to the seller and they will pay taxes. We have to be involved before escrow closes because escrow has to have the directions that the money comes to us, not to the seller. So again, other than this, everything about your listing of the property is exactly like any other listing of real estate. All right. So now let's get into the important rules of the 1031. The first one to know is when you sell the property, how long do you have to buy the next property? The answer is you have 45 days from the day escrow closes to identify what you're going to buy and 180 days to actually buy it. 45 days to get into contract, 180 days to close escrow. Now, technically, do you have to be in contract by the 45 days? Technically, no. Technically, you can identify up to 3 properties. And when I say identify, I mean you give us 3 property addresses, not just a house in Cupertino. It has to be the exact address to the property. But if you identify 3 properties to us, and then on day 46, they're all sold to somebody else, then you're out of luck. So really, I always encourage people by day 45, you want to be in contract, your inspection's done, your loan approved. You want to be locked into a property by the time you get to the 45 days. Now you have 180 days to close the escrow, but unless you're buying new construction, that 180 days is almost never an issue. The 45-day clock really is the driving clock. Now, about that 45 days, it starts when the escrow closes. So one thing to remember here is ask for longer escrows. The longer before escrow closes, the longer before the 45-day clock starts. So, don't accept a 10 or 15-day contract if you don't know what you're going to go buy. Ask for a 30, 45, even a 60-day contract. The longer before escrow closes, the longer before that 45-day clock starts. So that's an important thing to note. I will also note at this point, there is something called a reverse exchange where you buy first and then sell. It's a more complicated transaction, and we need to be involved before you buy the property. But if you have a client who's afraid of not finding a property within the 45 days, and they've already found something that they want to buy, call me. I will walk you through the process and go through how we would need to structure a reverse exchange. It does not work for everybody, but it does work for a lot of people. All right. Next part of the question is, how much do you need to reinvest when you're doing an exchange? The answer is very simple, all of it. Not the equity, not the profit, everything. If the property sells for $2 million, you need to go buy for at least $2 million. Now, can you buy for more? Yes. Can you buy 2 or 3 or 4 or multiple properties that add up to 2 million? Yes. Can you buy for less than 2 million? The answer is actually yes, but you pay tax on the difference. So if you sell for 2 million but only buy for $1.8 million, then you pay tax on that $200,000 difference. It does not invalidate the exchange. It just means you have what's referred to as boot. Boot is what you pay tax on. So equal or greater to what you sell the property for. Part 2, equally important, all the equity, all the cash that comes from the sale, all has to go as a down payment on the next property. Cindy, does your company also do loans?
We don't do loans.
Good. Because one thing I always recommend to lenders is find out how much money is in the exchange. Because if you give too big of a loan and there's cash left over, that cash becomes taxable. So equal or greater, use all the cash. Obviously, if there was a loan on the property, that loan is going to get paid off when escrow closes. But it needs to be made up when you buy the next property. So you either need to get another loan or bring in your own cash to make up the value of that loan. Anything that you don't spend is considered to be taxable, what we refer to as boot. So easy way to remember this: did you buy property equal or greater in value, and did you use at least all the equity that came from the sale? As long as you've done both of these, then you are deferring all your taxes. In a nutshell, that's the 1031 exchange. You're selling investment real estate, you're buying investment real estate. You have to know what you're going to buy within that 45 days, and you have to spend all the money on the next one. But overall, it's actually a fairly easy process. You're just selling something and buying something. Our job is just to help you through the process. There are some very common myths people have about exchanges. It used to be that exchanges were swaps. So I like Cindy's property, she liked my property, and we would just exchange real estate. It had to be done the same day. That's actually how 1031s used to be, but not anymore. The law changed in 1984, so over 40 years ago, that now allows a completely different type of transaction. A lot of people think the exchanges are expensive and messy and are going to get you audited. Not true. They're easy, they're cheap, and there is no expectation that you're going to get audited any more than any regular transaction. So not a problem. A lot of even accountants don't know that a property can be both a primary residence and an investment at the same time, but you can. It's a common misconception that that's not the case, but you can. So again, these are just some of the myths that people have. Other next thing is, what are some of the common problems we have when people do exchanges? First one is family. There is a restriction in the 1031 code when you buy and sell among family members as part of a 1031 exchange, especially if somebody wants to buy replacement property from what we would term a related party, obviously like a family relationship. A common thing people ask here is, I want to sell my rental and buy my daughter's house from her, or I want to buy my parents' house out of the estate. No, you can't do it. There are restrictions with those kinds of transactions. Bottom line, when anybody wants to buy or sell among family members as part of an exchange, call me. I'll walk you through it. If they can do it, great. If they can't, I'll tell you why and how to, and hopefully how to get around it. And sometimes you can't get around it. Seller financing. Seller financing is not too common in urban areas like the Bay Area. It's very common for commercial real estate. It's also very common in rural areas, farms and stuff like that. But seller financing and 1031s don't mix. Seller financing is is carrying a note back, so the seller acts as the bank. That's a problem if you're trying to do an exchange. Third, vesting. What's important in an exchange is it has to be the same taxpayer selling and buying. Cindy can't sell a property and give the money to Serena to buy the replacement. If Cindy sells, Cindy has to buy. One thing I do recommend, whenever you get a new listing, you open escrow at your favorite title company, hopefully Fidelity Title, because that's where Jennifer Chu Lee set us up to come speak with you. Get this magical document called a prelim title report. Look at it. Please make sure the people on title are who you're dealing with. Um, Sometimes people want to break up partnerships or break up LLCs, or sometimes they want to add a spouse or somebody else on title to the property. That's a problem. It needs to be the same taxpayer selling and buying. So be very careful. And if there's any question about that, you're welcome to call me. But foreign sellers. Foreign sellers can do exchanges. So if somebody does not have a U.S. citizenship or permanent residency, they can still do an exchange, but they will probably be subject to FIRPTA, the federal withholding, and they must have a tax ID or social security number. Bottom line, when it comes to foreign sellers, again, if you're dealing with somebody who's not a U.S. resident or permanent citizen, please let both the exchange company and the title company know up front early in the process, because there's extra paperwork to be filled out and filed with the IRS. It's a more complicated transaction. Can they do it? Yes, just a little bit more complicated. Next is divorce. If somebody wants to do an exchange and they're in the middle of a divorce, it is very messy. And sometimes we have to get the client's accountant involved, because the truth is, until you're actually fully divorced, the IRS still treats you as one person. So be very careful about that. Lastly, the intermediary, what we do is not regulated. And there are a lot of small one-man operations out there for people who do exchanges, who want to help you as the intermediary, but they have very little in the way of bonding or insurance. Please only work with big companies. We are the biggest company by far over everybody else. We're the sister company to Fidelity Title and others. We have the bonding and insurance, making sure your money is safe, because our job is to hold your money. And if we're holding millions of dollars of your money, you want to make sure it's safe. Now, why do people do 1031 exchanges? The simple answer is, it is not just to defer taxes. You mostly do an exchange because you want to buy something better. Now, what does better mean? Better means whatever the client wants it to be. It could be, I want to buy something with more cash flow, or something easier to maintain, or maybe they're moving and they want to move their rentals to closer to where they are going to live. Maybe they ran out of depreciation and they want to buy something that's going to create new depreciation. Maybe they want to do some estate planning and exchange so that each kid or grandkid knows exactly what they're going to inherit. The key here is that you do exchanges because you want to buy something better to what you own today. That term better is subjective. It really depends on what the customer says what they says what they say they want to do. So the reason I bring this to your attention is when you're dealing with investors, it's good to ask them, what are you looking for out of your real estate? What do you want? Do you want better cash flow? Do you want better location? Do you want something easier to manage? What are you looking for? 1031 is the tool that gets them from what they own today to what they want to own tomorrow. It's a very powerful tool. But 1031 is much more than just deferring taxes. It's getting people into the property they want to own going forward. And with that, that's the end of my talk. Let me add a few things here before I open it up to questions. First thing to remember is my job is to help you help your clients. You are never expected to become experts in 1031 exchanges, just like you're not experts in loans or in title reports or in termite control or anything like that. Your job is to be the best realtor that you can be. You want to surround yourself with people who are, as part of your team, help you help your clients. That's what I do. My job is to help you help your clients. Use me, and don't be bashful about it. I'm happy to help your clients anytime. My entire job all day long is talking to people about exchanges. That's all I do, and that's all I want to do. All right. I will also add, I do have a newsletter I put out on 1031 and tax related information. If you want it, send me an email or send me a text. It comes out once a month, so it doesn't come out very often, and it gives you some information about exchanges and anything that may be happening with them. So if you're interested in doing so, great. With that, that's all I have. Cindy, are there any questions in the chat box to answer?
I think there's two questions in the chat box. One is
Okay.
from Maria and one is from Alex. Alex is not here. So if you can help answer these two questions, it's going to be very helpful.
Okay, and I'm having a hard time for some reason. There it goes. Okay, there it goes. Let me go to the checkbox. All right. Can I do a 1031 exchange for a piece of land to buy a single family house and make the single family house a primary residence?
It's mine.
The answer is no, you cannot buy the property as a primary residence.
Oh,
There it
why
goes.
is so noisy?
Hold on here. There we go. All right.
Okay.
So you cannot buy a primary residence. Now, if you want to buy land, when someone wants to buy land as part of a 1031 exchange, I always ask the question, what are you going to do with the land? If you're going to buy it and immediately build a primary residence for yourself or buy a spec house, no, it doesn't qualify for 1031 because you're not buying it for investment purposes. If you're buying the land and just holding it as land for a few years, or you're buying land and you're going to build a rental on there, then that's perfectly fine. But be very careful about wanting, if your intention is to buy a property that ultimately you want to convert into being a primary residence, you need to plan to rent it, to use it as an investment for at least 2 years before you do anything else with it.
Hi, Ron. This question is about selling land and buying a single family house and
Oh,
later using it as a primary residence.
so again, selling land to buy a single family house, that's fine, but you need to rent it for at least 2 years before you move into it.
Okay, awesome. Thank you.
Okay.
And also,
Um,
is there like a time limit for the reverse exchange?
yes, a reverse exchange is exactly like a regular exchange. You have 45 days. In a regular exchange, you have 45 days to tell us what you're going to buy, and that's the hard part. And 180 days to buy it, which is the easy part. In a reverse exchange, you have 45 days to identify what you're going to sell, which is the easy part, and 180 days to sell it. So the key in a reverse exchange is you have to be able to sell what you're going to sell within that same 180-day window.
Thank you.
All right. The other question had to do
Yes.
with,
Another question. So if
yes,
you convert, like, revise the rental property to your primary resident, do you have to pay for the tax? Like the,
good, very good question. The answer is no.
okay.
Converting the property does not create a tax situation. So whether you convert the property into being a rental or into being a primary residence, that's fine. Now, I will say, if you move into the property and convert it to being your primary residence, if you ever sell the property, then there will be some taxes to pay. But as long as you own the property, no, you do not have to pay the taxes.
So if like, for example, like my son or my daughter sell the house in the future after I die, so they still don't have to pay for the 1034.
Right. So if when they
Even
inherit
though
the
like even though revised to the like a primary.
right, sure. If they've converted, if it's been converted to primary, the fact that they've inherited the property, whatever they do with the property is up to them. They can sell it right away and pay and have no capital gain, or they can move in, or they can rent it out. Whatever they want to do. The fact that you moved into the property before that makes no difference.
Oh, okay. Thank you.
All right. There is a question here with regard to Delaware Statutory Trust, or DSTs. Let me explain what those are. There's a common thing people do especially when they get older, retired, and they're tired of actively managing real estate. There's something called a Delaware Statutory Trust. What that is fractional ownership in commercial real estate. So instead of buying an entire shopping center or an entire apartment building, they buy a percentage of that property. It qualifies for 1031 because you still have direct ownership of a percentage of the property, but it's much less management. It's very predictable cash flow. So those are two very good things. The biggest negative to these is that they are not liquid. You cannot buy a property and they're not liquid. So you can't, if 2 years down the road you say, oh, I found something I want to do another exchange for, you're not going to be able to sell that property. You're usually tied into those properties for 4 to 8 years until the sponsor decides it's time to sell. So it's very similar to an old limited partnership where the general partner makes all the decisions and you're just one of the limited partners, along for the ride. So that's the biggest negative to DSTs. We do see a lot of people go into them because people want to get out of actively managing real estate and want to find properties that have positive cash flow, which these properties do. So that's the question about the DSTs. Does anybody else on the call today have any questions they want? If you don't just want to unmute yourself and ask away, please do.
I think there's another question from
Oh,
Alex in the chat box.
I may have missed it. Sorry. Where'd it go
The
here?
first one I
Oh,
posted. Yeah.
I'm sorry. I only see two.
Oh, let me.
Can you read it for me?
Yeah. Oh, I'm sorry. Let me send one more time.
Oh, there it goes.
No, that's your.
That's you. It's me. Yeah.
His
Oh,
question is, what's the
yeah. Okay. So the main risks again for the DST is, first off, you are buying real estate. Very important to realize you are buying real estate. So any risk of owning real estate is the same risk. So if for those of you who remember the real estate market back in 2008 and 2009, when everything kind of the world collapsed, a lot of real estate went belly up. There's always the risk because it's real estate. The biggest risk though is, again, the fact that you can't sell whenever you want, and that is a big problem for a lot of people. In answer to the other part of this question I see now is with regard to a failed exchange. A lot of people will use the DST as a backup or as a filler. I was just dealing with a client this morning. She's selling for $2 million. But she's already found a property she wants to buy for $1.7 million. So she's going to have $300,000 of boot. So she's going to use a DST for that extra $300,000. Also, a lot of people will use a DST as a fallback. If it's day 40, I haven't found anything. I don't think I'm going to find anything by day 45. Fine. Now I'm going to go into a DST. So yes, a lot of people will use a DST as a filler or a fallback. They're not for everybody, because a lot of people don't like to lose control of their assets. But it does work for a lot of people.
I see.
Anybody else have any questions? Well, in that case, I want to thank everyone for coming today.
Yeah, I was
yes.
trying to. I have another question. I'm not too sure. I actually asked Jennifer this question. So, what about reverse 1031? Because what's the catch and what's the difficulty of doing a reverse? Because normal logic, right? Because if I want to buy a house, because everybody knows it's very hard to buy in Bay Area rather than selling for most of the properties, right? So if I'm a buyer, if I'm an investor, I might think that, hey, let me try to score a a property first, right? So I don't have to worry about the 45 days, because if you ask me, can I sell my property in 45 days? Yes, right? I mean, that's relatively easier and closing 180, but if I'm gonna have to buy something 45 days, and what if I identify 5, then I try to bid, and then none of these are successful, then it's gonna be a mess, right? So that's why I'm kind of trying to see but when I was talking to Jennifer, she said you need to have the twice the money, blah blah blah, which I did not quite understand. So I don't know if you could elaborate this a little bit more and tell us what's the catch if we want to do a 1031, a reverse exchange.
The first thing to realize, John, when you do a reverse exchange, is that you cannot buy that property and then call me, because if you buy that property, you now own both, and you cannot do an exchange.
I know. Yeah, you gotta have
I'm just educating everybody else.
Yeah, okay, got it.
So you can buy. So what happens in a reverse exchange is you come into escrow with the money to buy that property, but we buy that property. So let's say you want to buy a property for $1 million. You bring the $1 million into escrow. We, as the intermediary, buy that property and hold it for up to 6 months until the other property is sold. The biggest issue here is the funding. If you have the cash to do it, it's very easy. But if you need to get a conventional loan, it's very difficult, because conventional lenders don't want to lend you the money and have us on title to the property. And that's the biggest negative to it. I have clients who do exactly what you're saying, Sean. They actually love reverse exchanges. They have lots of money, and they just find the property that they want to go buy, and
I see.
And we do the reverse exchange. But the funding is the hard part.
I see. This actually is perfect. So that's kind of explaining to me, because basically when the loan do a funding, they want to use the property as a collateral, and they want to make you be responsible for the loan. But it's actually going to be another entity, which is the 1031 exchange company. I don't know what's the name they call it, but I know there was a name to actually hold the property. So technically by law, the owner is another entity or another person. Okay, got it. That's why.
So what now there are a couple options. I mean, one option is there is something called a hard money or bridge loan that are private money lenders. But I also encourage people to borrow against their primary residence or borrow against their other assets.
Like a HELOC.
Yeah, exactly. Get a HELOC against their primary residence or other rental properties. If you can come up with the money, I always tell people, borrow from family members. You go rob a bank. I don't care, as long as the money shows up in escrow. But the truth is, most people would love to get just a conventional loan, and that's the problem.
Okay.
I will also add that a reverse exchange is more expensive, whereas a regular 1031 1-for-1 is about $1,250. A reverse exchange is going to be, depending on a few factors, between $7,000 and $9,000. So it is more expensive also. But the freeing yourself from the time and finding just the right property you want to buy does make that extra dollars worth it for many people.
Yeah, got it. Yeah, that actually makes a lot of sense. This exactly answers my question, so I can talk to my client. Yeah. So they were thinking about this and blah blah blah. Then I'll tell you. So that you do have options. So I think what Jennifer was trying to tell me is that it's going to be higher cost. Either you get a hard money loan with a higher interest, right, or whatsoever. Yeah, but yeah, okay, got it. So basically, you need to have the funding ready for that, and then the lender needs to approve, but that's probably not going to be work with any regular like major banks, right? Like Chase, Wells Fargo, Bank of America. I don't think
they're not going to do it. I guarantee they will not do it.
Yeah, got it. That's very clear. Thank you so much, Ron. Yeah,
not a problem. Anybody else? All right. Well, Cindy, thank you so much for having me today. I hope it was worth your time, and I'll send you the link for the recorded document or for the recording as soon as I have it.
Sounds good. Thank you so much. I think this is very helpful for everybody, and this is going to be, very educative, for us to share even whether ourselves to our clients. And you're gonna be the go-to guy. I know this company very well. I know that you're very very famous and trustable in the industry. Yeah. So we're gonna come to you. Okay.
I appreciate that, Sean, very very much. Everyone have a wonderful day, and I look forward to working with all of you.
Sure. Thank you so much.
Thank you,
Okay.
Ron.
Right.